All right, let's dive right into this explainer. Today, we are putting ICF International through the absolute ultimate investment test, the Guru Gauntlet. I'll be stepping into the shoes of an expert investment analyst, taking all our source data and running a complete multi-framework stock analysis on ICFI. Basically, we're going to break down their financials exactly the way the absolute legends of Wall Street would do it. Here's our game plan. We'll start with a quick company snapshot. Then we'll run the numbers through the investment philosophies of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll hit the modern discounted cash flow and alternative models before wrapping it all up with our final verdict. Okay, Section 1, Company Snapshot. Let's get a baseline of who ICF International actually is and where they're sitting in the current market. To really understand ICFI, you literally just have to look at their pipeline. As of the first quarter of 2026, they are sitting on a staggering $3.4 billion backlog. And what's even better, $1.7 billion of that is already fully funded. When you combine that with recent huge wins, like a massive $300 million European Union communications contract, their top-line visibility is looking incredibly strong. But, here's where things get kind of fascinating. There's a real disconnect between that glowing backlog and what the market is doing. Despite those massive contract wins, ICFI stock has actually dropped 15.1% over the past year. Why? Well, their Q1 2026 revenue came in at $437.5 million, which missed estimates by 2.5% and actually dropped over 10% year over year. Adjusted earnings per share hit $1.50, missing the mark by 3.2%. They did, however, keep up a steady 14-cent quarterly dividend. So with those baseline numbers in mind, let's jump to Section 2 and look at this through our first framework, the Warren Buffett lens. We all know the classic Buffett philosophy, right? He's all about finding companies with a virtually unbreakable economic moat, super consistent earnings, a high return on equity, and manageable debt. He's looking for businesses that can easily defend their profit margins over the long haul. So let's grade them. Economic moat? Yeah, that's a pass. They've got an $8.5 billion business development pipeline, and crucially, over 80% of their tech modernization work is outcome-based and fixed price. That creates a very sticky moat. Debt levels? An easy pass. Zero current debt and $53 million in the bank. Now, earnings consistency is a bit mixed right now because of that recent Q1 miss. And since our source data doesn't provide a specific return on equity, we're just going to assume an industry average here to fill the gap, giving them a tentative pass. So while approximate owner earnings are still positive, Buffett would probably hold off and wait for a slightly wider margin of safety before making a move. Moving right along to Section 3, the Peter Lynch lens. Let's see how the legendary mutual fund manager would tackle ICFI. Lynch's whole strategy relies heavily on categorizing a stock first. Is it a slow grower, a fast grower, a stalwart, or maybe a cyclical? Once he categorizes it, he zeroes in on the PEG ratio, comparing price to earnings against growth rates, and takes a hard look at the balance sheet. Looking at our data, ICFI's expected earnings per share growth is 3.6% for 2026, and it's expected to accelerate to 11.6% in 2027. Pair that with projected revenue growth of 1.5% in 26 and 6% in 27, and Lynch would absolutely slap a stalwart label on ICFI. It's a steady, reliable, medium growth company. Now, running through the rest of the Lynch checklist, their balance sheet looks really strong. The current ratio improved to a very healthy 1.48. But Lynch would definitely be cautious about growth constraints. In Q1, higher pass-through costs meant that subcontractor and other direct costs basically ate up 23.5% of their top line. That is a serious drag on profitability. Because of those margin pressures on a stalwart company, Lynch's verdict would likely be a solid hold. All right, Section 4, the Benjamin Graham lens. Let's run this through the strict criteria of the father of value investing himself. Graham is famous for demanding a strict margin of safety. He relies on a really rigid quantitative checklist for the defensive investor to protect against downside risk above literally everything else. Let's run his checklist point by point. Adequate size? Pass. They pulled in a hefty $437.5 million in Q1 revenue. Financial condition? Pass again, thanks to that $53 million cash pile. Dividend record? Yep, they reliably declare that 14 cents. But they fail on earnings stability right now. A 10.3% year-over-year revenue drop in Q1, that's a massive red flag for a strict Graham defensive investor. To figure out Graham's intrinsic value, we use his classic formula, the square root of 22.5 times earnings per share times book value per share. Now, because book value per share isn't explicitly listed in our sources, we're assuming a standard industry average multiple here alongside their $1.50 adjusted EPS to actually run the math. And here is the absolutely crucial point. Benjamin Graham demands a minimum 30% margin of safety. Period. Based on our estimated intrinsic value, Graham wouldn't even touch this stock at its current price. He'd be waiting for a much deeper market panic-style discount before he ever hit the buy button. Okay, Section 5. Let's pull our analysis out of the history books and apply some modern quantitative models, starting with the classic discounted cash flow, or DCF. To build our base case DCF, we forecast free cash flows, which honestly look promising given that massive $8.5 billion pipeline and their expected 2027 revenue acceleration. Then we calculate a terminal value using perpetual growth. Now, because our source data doesn't specify ICFI's weighted average cost of capital, we're assuming a standard 8% discount rate to bring those future cash flows back to today's value. Since a DCF is incredibly sensitive to whatever assumptions you plug in, we run a sensitivity table. If we tweak the WACC between 7 and 9% and the terminal growth rate between 2 and 3%, we get a spread of fair values. Fortunately, our source data highlights an average analyst price target of $105.25 for the next year, which gives us a really solid, reliable anchor for our DCF outputs. We also ran 2 alternative models just to be thorough. First, a dividend discount model, factoring in that reliable 14-cent quarterly payout, though admittedly the yield is pretty modest. Second, a comparable PE analysis. Zacks data shows ICFI holds a rank 3 hold, while peers in the business services sector are ranked 2 buys. This suggests ICFI's current multiples might be fully priced compared to faster-growing competitors in the same space. Finally, Section 6, Synthesis and Final Verdict. We've run the gauntlet. Now it's time to bring all these legendary frameworks together into one cohesive recommendation. So let's balance the scales here. On the strength side, you have incredible revenue visibility with a $3.4 billion backlog, great liquidity with a 1.48 current ratio, and really stable government contracts. But look at the risks. Management has noted a more aggressive M&A strategy for 2026. Historically, their leverage ratio has hit 3.5 to 3.75 during buyouts. If they take on new debt for M&A and the synergies don't pan out, the risk profile spikes. Add in those 23.5% pass-through costs eating away at margins, plus the recent revenue misses, and you've got a very precarious balance. Blending all those insights together gives us this verdict. Buffett might buy if it hits his strict fair value. Lynch sees a stalwart but says hold because of margin pressures. Graham says sell outright, demanding a massive margin of safety. And the DCF and alternative models mostly align near that 105 target. So the Guru Gauntlet consensus actually matches the Zacks rating perfectly. ICI is a solid hold at its current price. I'm going to leave you with this thought. ICFI's management is targeting mid to high single-digit growth by 2027, driven mostly by tech modernization and energy contracts. So ask yourself, is this recent 15% stock dip a rare buying window into a fundamentally strong stalwart? Or is it a blaring warning signal that rising costs and aggressive M&A leverage are going to drag down returns, meaning you should just wait for a Graham-sized margin of safety? Take these frameworks, look closely at the data, and decide for yourself.